All right, well, I think we can go ahead and get going. People will still be logging in, I'm sure, but we've got a lot to cover tonight. So I want to go ahead and get started. If you weren't with us right at the turn of the hour, welcome to Phoebe Long Beach. If you haven't been to a Phoebe meeting before, Phoebe stands for Investors by Investors. We are an investment, real estate, education, and networking club that's all about bringing people together, learning about investing, mostly real estate, but sometimes alternative stuff too, with no sales pitch, zero sales pitch. So there's no weekend seminar coming at you at the end here. This is all real information, data, knowledge that we have to share with you. We'll often rotate through guest speakers, panel discussions. It's a different topic every month. But I've got David Coe here, who's the chapter leader and one of the Phoebe directors from Phoebe South Bay. Dave is a residential realtor here in the South Bay, and I am a commercial multifamily broker in the South Bay. And so our skill set together makes an excellent night for talking about market data. So we've been doing this meeting now a couple times a year since the pandemic started, because ever since 2020, everyone's trying to guess the future and wondering what the heck is around the corner next, right? It's confusing times we live in, and who knows? So we're doing our best to bring you real data without the slant, without the sensational news, and figure out what's happening. And before we get into the slides, we were having a little chat before we got started, and I think it's an interesting anecdote about the perspective and the mindset of people right now, right? So it seems like maybe we're already in a recession. You could say that perhaps we are, looking at some data points.
I think we're going to find out in 2 weeks, right? Like they released, we've already have 1 quarter of negative GDP. Right. I think they released the next report, like next week. So yeah, big shock. We're in a recession, but I think that's the fun part is that real estate actually does pretty well during a recession. And I think that's a lot of what we're going to kind of talk about tonight. And I think our slides will start to demonstrate that as well.
Totally. And the interesting thing, I think, for most people that are in the space right now is it's been a long time since we had a regular old recession in the country, right? However you define it, whether it's 2 quarters of negative GDP or whatever. The last recession most people remember was 2008, right? Subprime crisis. Things got really nasty. I know I had just started investing then. I bought my first property in 2006. And so that's what everybody's expecting. When you say recession, you think, okay, there's going to be 30% discounts on everything. There's going to be blood in the streets and foreclosure city. On the other hand, before that, we were trying to remember while we were waiting for people to come in the call, what we were doing in the last recession. That was 2001 was the last time we had a recession in this country, right? We had a pretty bad one. We had the dot-com bubble burst. I was in undergrad at that point, and I was joking around that I was thinking about what party to go to that weekend. It certainly didn't register to me what was happening in the real estate industry. Malcolm is our operations manager here, and Malcolm was in elementary school at that point in time, so I'm not sure that he was paying attention to what was going on. And maybe that's the same, that a lot of people had going on. Is it takes 21-year memory of being basically a participant in the space to remember what a regular recession looks like. So,
and Anthony, I had a job working in marketing and advertising, and I still had no idea what was happening with financial information. Was also looking for the next party. Yeah, so I really hadn't grown up that much since my undergrad years.
Yeah, so here we are 21 years later, and we're figuring it out one day at a time. So this should be fun. We'll unpack a bunch of stuff. I'm going to get us started with the multifamily information. And yeah, Malcolm has been studying real estate since he was 5. That's because Malcolm's the master behind all of these charts, actually, for the most part. Malcolm and Ashley, who you might see there, I've got to give them credit, wave to your adoring fans. They're the ones who crunch all these numbers, organize the data for us, and they're really amazing. We've been keeping track of local market data here at Buckingham since 1965. And I know I said Malcolm's young, but he's got a time travel machine. So we've been going back and doing that. But oh no, not really. That's the fascinating thing here, though, about being involved with a company like this. I took our research over in 2013, and we have all this old data going way back into decades past from times that most of us don't really remember. So what we will do tonight is unpack some of that. We'll look at some of the primary research that Malcolm and Ashley have just done on our local market. We'll try and make sense of what's going on there versus what you're hearing in the headlines and some of the macroeconomic stuff out there. This is highly localized information. So keep that in mind, that that's going to be really different from what you might see in some national, reports or news articles or things like that. I'm trying to figure out how to go non-full screen here. This is driving me crazy. Now we'll just run with it. Okay, so for people who have not been to something like this before, or you haven't studied commercial real estate, I always like to cover the metrics here, just so we're all talking the same language. These are the useful terms and formulas that most people use for multifamily deal analysis. So very simple. These are probably the three most important ones you need to know. And this is how it works. So you've got the gross rent multiplier. These are metrics for valuing buildings based on their income or comparing different sales to each other. And the gross rent multiplier is the property price or the value divided by the gross scheduled rents that a building produces. So a simple example, if you've got a $1.5 million property that generates $100,000 in gross scheduled rents, you would say that the gross rent multiplier of that building is 15. So that's just the math, but what does that really mean? Who cares, right? That's just a number that it spits out. Well, it's kind of like a PE ratio with stocks. It's a multiple. So the lower, the better. If you think about it and you come back to the units in the equation here, if we say your GRM is 15, that's the same as saying 15 divided by 1, which is the same as saying for that property, you're paying $15 in purchase price for every $1 in gross scheduled rents or revenue that year. So I'd rather pay 12 bucks for the same dollar of revenue. I'd rather not pay 20 bucks for the same dollar of revenue, but it's a really useful comparison statistic so that we can tell what properties are going for in one area versus another. Generally, more expensive, more desirable areas trade for higher multiples or higher GRMs because they're more desirable. They're seen as less risky by the marketplace and by investors. So that's probably the simplest possible metric to look at buildings. It eliminates a lot of subjectivity because there's no expenses in that equation. Now, also, you have to be aware of that. So the cap rate is the other side of the same coin. That is a similar number, but after expenses. And with the cap rate, the income of the property is in the numerator of the equation instead of the denominator. So the math for the cap rate's right here. It's NOI divided by the property price or the value. And the NOI is the gross scheduled rents minus the operating expenses before any mortgage payments, which we would call debt service. So the NOI is a more accurate representation of the yield on the purchase price of the property. And it's really useful for that because then you can compare the yield on a property versus the yield on other alternative investments, yields on other properties in other markets that might have different expense ratios, yields on other asset classes like industrial versus multifamily versus, whatever, storage. And so it's really useful for that. The problem with cap rates are if you don't have the correct expense data, you don't have the correct cap rate. So if you go on to LoopNet or Zillow or whatever, and you're looking at apartment building listings, it's really hard to make sense of what the real cap rate is when you're looking at a deal. So you often see people advertising 6% cap rate, 7% cap rate, right? But maybe they're using market rents and they're not counting any property management expense and they're not counting any vacancy allowance or anything like that. And obviously that's not a very good number versus one that's way more accurate and including all that stuff. So
Anthony, are you saying that brokers are misleading?
No, brokers would never do that. Now you can have our word that if you look at a Buckingham deal, the expenses are correct to the best of our knowledge. That's not necessarily the case the rest of the market. So my apologies for the rest of the industry. But suffice it to say, you really need to have accurate expense data to have cap rates be a great measure when you're comparing buildings to each other. That said, it is the primary metric that you'll hear about when you go to seminars, listen to podcasts, read books. Everybody wants to talk about cap rate because it does equalize the comparison if you have good data. I personally prefer the GRM because of that subjectivity problem. Now, the debt coverage ratio is another important one. You're not going to see debt coverage ratios in market statistics, but debt coverage ratios are really important for figuring out the lending piece. And that's what commercial lenders use to underwrite deals. So similar to a debt to income ratio on residential, except the debt coverage ratio really only applies to the building when it comes to commercial real estate. And the math on that is it's the net operating income divided by the annual debt service. And the annual debt service is a fancy word for the mortgage payments for the whole year. So that includes principal and interest. And in our local area, generally, lenders are willing to loan on a debt coverage ratio of equal to or greater than a 1.2. So that means that the NOI divided by the annual mortgage payments has to equal a 1.20 or higher. In other words, they want you to have a 20% pad on top of the mortgage payments for NOI, which means they're going to force you to cash flow. Now, that is an interrelated concept with these other metrics, because the higher the GRM, the more you're paying for every dollar of annual rent revenue, which means the less revenue is available to service the debt, which means it's going to require more of a down payment, and the building is going to qualify for a lower loan relative to the purchase price because you paid more for every dollar of annual rent revenue. By the same ticket, a lower cap rate means that the building is yielding you a lower dollar figure before paying for debt service, which means it's going to require a higher down payment and qualify for less leverage, which of course impacts your returns and everything else in the capital stack, which that gets to be a lot of complicated stuff that we can talk about on another day. But these are probably the three most important metrics. They're right back there on the wall in our conference room if you ever come in. But we're going to talk a lot about GRM and cap rate, especially today. So I wanted everybody to understand that a little bit. A couple conceptual points on cap rate. It's an often misunderstood term. It's really easy to kind of understand the math and say, great, I'm going to go find the highest cap rate I can possibly find. That's going to be the deal I'm going to buy because that's going to have the highest cash flow. And on paper, you would be correct. In practice, though, going out and finding the highest cap rate possible is telling the market that you are going to go and find and buy the riskiest deal you can possibly find. Because at the end of the day, what a cap rate is that's the yield investors are willing to accept for invested capital on that building in that area, in that submarket. And so it has that effect of requiring a higher return for a higher level of risk that investors perceive they are taking on for investing in that area and that asset class. So if you run out and try and go find yourself a 15 cap, you might have problems with managing that building and realizing your 15 cap. Whereas there's a nice middle ground there where you can have a high enough cap rate that you can qualify for good leverage, get great returns, but a low enough cap rate where you're going to experience some great appreciation. There's usually an inverse relationship between appreciation and cash flow there, and you're still going to be able to manage the building relatively easy with somebody like Chris Jenks at the helm, taking her easy, having a martini. I love it. Okay, so let's dive into the data. Here is 56 years of apartment building values right here in what we call the Greater South Bay, Southern California. So this is our own market research. This is going to be different from anything you see from any other source. We have been keeping track of these numbers since 1965. Jack Buckingham started the company way back then, and it's been a data-driven place ever since then. This is on duplexes and above. So a lot of multifamily data that you might see really focuses only on 5 units and above. Our data focuses on 2 units and above because a lot of people are looking to get started, and those 2 to 4 unit properties are great places to get started. This is just price per square foot going from about LAX down through Long Beach. So that's what we would refer to as like Greater South Bay. If you take the 105, maybe down to the 605 and where they intersect, that's basically what we have here. So in 1965, we're at $14 a square foot, if only. And at 2021, we ended at an average of $485 a square foot. Obviously, values are somewhat subject to the business cycle, which is of course why everybody has logged in today. And we're all here to figure out what's happening next. However, the overall trend is overwhelmingly positive, right? Every time you've got a recession and a recovery, you surpass the previous high. You do have downturns here and there. They're usually not too bad, with the exception of our notable subprime crisis that we caused. And if you take a 56-year average rate of appreciation on the value of properties, properties in our area, multifamily properties in our area, go up at about 6.5% every single year. So that's fantastic. That's the benefit you get out of investing in Southern California and putting up with some of the madness that you have to deal with here. The numbers are really strong. You'll also notice that there are recessions in here where values didn't necessarily go down, right? We were talking about 2001. There it is. Their values just went right on up straight through this recession of the dot-com bubble bursting. So it's not necessarily that real estate does terribly during recessions, but when we're causing it, yeah, that can happen. So everyone's wondering where we're going from here, and we're going to look at a whole bunch of statistics and maybe make some guesses on that. So the data that goes into our market study gets published each quarter into a table like this. And Malcolm, could you throw the market research dashboard into the chat real quick? Let me show you, if you guys want to play with this stuff on your own, I'm just going to share. We have a brand new snazzy interface that you're welcome to use right here. So we've built a market research dashboard here at our company that allows you to filter, slice and dice, and access our own research for free in our website. Just hit that link. We promise we're not going to sell you anything but apartment buildings, and only if you want them. And you can filter by city up here if you want. You can eliminate or do only the city if you click it here. You can look at it, drill down by zip codes. You can exclude unit counts. We got a couple SFRs in there that end up in residential income. You can exclude 2 to 4s. You can only look at 2 to 4s if you want. You can look at it by MLS area if you're curious, diving into an individual neighborhood. And then of course you can do a time frame. So you can hit advanced on the time frame, and if you want to look at last year, this quarter, whatever, that drives the chart below. So we've got all this stuff packaged into PowerPoint, which I'll go back to because it's easier to read. But if you do want to play with it at some point, feel free. It's nice to manipulate. It's all interactive. This chart here pulls all of the data that you have in your filter set. So the default view on this table at the bottom is actually an average of 9 years of data. So if you're going to look at this table at the bottom, I recommend picking 1 quarter or 1 year. But we're really proud of this. This is all of our primary research that goes into this. We spent a lot of time on it. So just wanted to make sure everybody's aware of what we have here. So here is the same data just displayed on a slide. This is our first quarter 2022 market study for that area. So here's the volume, 226 total transactions. And you can see some cities have a lot more volume than others. Pretty normal, but Long Beach is usually responsible for about half of the total transaction count in this area. This is everything from the MLS. So this is not, this doesn't include off-market deals. This doesn't include deals that only were on CoStar or LoopNet, although most deals that are on CoStar and LoopNet also end up in the MLS. And a lot of deals that are on the MLS are not on CoStar and LoopNet. So there's some, it's a different data set than you might see in some other articles, because CoStar is sort of the industry giant that you tend to read articles about. And when you read stuff from the MLS, it's usually coming from CAR or NAR, which is more focused on single family stuff. So this is what we do. We go through each one of these sales, all 226 of them. Thank you, Malcolm and Ashley. And they correct all the errors in the listings because they are numerous. Sometimes people don't put the right stuff in these listings. So we fix the issues with using annual numbers instead of monthly numbers on rents, or an extra digit here or there or whatever. And this is scrubbed to eliminate weird outliers, data errors and stuff like that. This spits out our average GRM on each one of these sales in each one of these cities, our average cap rate. Now the cap rate, we are eliminating the subjectivity here by erasing the broker provided expenses entirely. And we use a 35% flat expense ratio for separately metered properties and a 50% expense ratio for master metered properties, which tends to be about right in my experience. It's going to be different depending on what amenities and stuff you have, but really that's a pretty good estimate. And then you have your price per square foot and your average price per unit, or you'll hear people call that price per door as well. So here's where we landed on all this stuff. 19 times gross on average in the first quarter, 3.6% cap rate, 527 a foot average price per square foot. and 453 price per door. Now I know you're saying, yeah, but the second quarter's over, and I just wanted to show the first quarter to compare second quarter with you. So has the crash begun yet? Is the question on the tip of everybody's tongue. Unfortunately, the answer is no, it has not. It's basically exactly the same. we're almost totally flat from first quarter. 257 sales, so more volume, which is average, that's normal. First quarter is usually kind of deals closing out that might have been put into contract in December, which is a light month. Usually January is also pretty quiet. GRM barely down, 18.8 and 19, statistically insignificant in my mind. That could be because there were a few more sales in less expensive areas. Who knows? Cap rate exactly the same. Price per square foot identical. There's the two quarters again right here. Price per door barely any change. A little bit up, 453 to 457, but for all intents and purposes, exactly the same. So that's great, but where are we going and where have we come from? Now, we also like to split this out by 2 to 4 unit versus 5 and up. So 2 to 4 units really price kind of differently because of the way that they appraise. They appraise on the sales comparison method. Buyers can generally use 75% loan to value if they have the income in their own personal life. And you get those 30-year fixed loans that are resold to Fannie and Freddie. So people pay a premium for that. So the 2 to 4 unit sales, also by far the majority of the sales that are happening. Of those 250 something, 200 of them are 2 to 4 unit small property sales. Really a lot of that inventory in our area, which is great for people getting started. Those expense ratios tend to be nice and low too on these properties. They're pretty basic, easy to run, easy to buy. GRM was 19.4 there. Cap rate was 3.5. Price per square foot of averaging on 556. You can obviously see the range here between different cities, right? Manhattan Beach, usually notoriously the highest one at 1334 a foot. Hermosa, 1223. Where's my Redondo? Usually around 1,000. Oh, 735. What a bargain. El Segundo more expensive than Redondo last quarter. That's surprising. And then you've got all these other cities that are generally the places where people are doing more investing because the numbers just work out a lot better. And those are in the 400s and 500s. So that would be Gardena, Hawthorne, Harbor City, Englewood, Long Beach, Pedro, Torrance, and so on. Price per door also, you get over $1 million per door in Hermosa and Manhattan, which, you know, gorgeous stuff, obviously, right? You're going to pay for it. Here's the 5+ metrics. This is really interesting. So this could be worth paying attention to if you've got a 2 to 4 unit property with some equity in. This might be, and you're considering how to take advantage of the market right now. This is something I would look at. So I'm going to flip back to 2 to 4, 19 times gross, 3.5 cap, 5+, 16 times gross, 4.1 cap rate, right? So you've got a full 3.5 almost multiple discount for buying a larger building. That means a 5 unit versus a 4 unit, you're going to get 3.5 times the annual gross scheduled rents of a discount on price compared to the same 4 unit next door to that 5 unit. Now, typically that's because you're putting a bigger down payment down on those deals. It's that debt coverage ratio analysis that changes everything. You can't always do 25% down. In fact, right now you pretty much can't do 25% down. But you have a better ability to control the value on those properties. And because that higher cap rate and that lower GRM, you're going to get better cash flow. And here's the other interesting thing of what's going on right now. During a lot of the beginning stages of the pandemic, the debt on the 1 to 4 unit properties for investment loans got really cheap for a while, down in the 2s. And the 5+ stuff moved in a tighter range because those lenders are generally holding those loans on their books, their balance sheet loans or portfolio loans, as we call them. Now, yeah, it's inverted and it's gone back to the way it normally is in a regular market. Typically, commercial debt is a little cheaper than residential debt. Now, residential debt on a 4 unit is around 6%. I think it's mid-5s to 6%. And debt on one of these buildings, a 5 and up building, you're going to pay around 4.5. So that's actually still a very reasonable rate. I know the interest rates are a top topic of conversation on everybody's mind. So if you've got a 4 unit with a lot of equity in it right now, you've simultaneously got great value because you have a huge spread on your multiple. And if you were going to refinance it, you'd be looking at a pretty high interest rate. That might be a great exchange to sell the 4 unit and trade into a 5+, a little larger building where you can get a good interest rate and a better cap rate at the same time. And much more attractive price per foot and price per door here. So that's a great exchange for people that have gotten started. They've added some value, and we've got a lot of clients doing that kind of thing right now. So that's been a really interesting. That spread between those multiples on those two has not been that large until more recently. That's been the case over the last 5 or 6 quarters. So interesting to pay attention to. Typically, the spread is more like 1 or 2. All right, so let's start looking at some trends, because I'm sure this is what everybody really wants to see. Those numbers in a vacuum don't mean a whole lot unless you pay a lot of attention to the market. So first of all, sales volume. Whenever we're in uncertain times like we are right now, we always want to think about what are the leading indicators that might tell us about changes in the market in the immediate future. So sales volume is a great leading indicator. How many transactions are being done, right? If sales volume dramatically drops off, you're looking at probably a disconnect between seller expectations and buyer expectations, right? And that's certainly anecdotally probably what you're hearing if you're talking to people that are in the market right now. It's definitely changed. The equilibrium's different these days. It's easier to be a buyer for sure than it was a few months ago. A little harder to be a seller, but still not a ton of inventory out there. We'll look at that in a minute too. That's another great leading indicator. So as far as sales volume goes, Q2, we saw that 250 number. We're still right in a really tight range here. This is not unusual. If we go back and look at seasonality, we are a little lower than Q2 2021, but 2021 was the highest volume multifamily sales year ever on record, period. So, maybe there's some undue stimulus to the market going on there from all that super cheap debt and money floating around. Q2 2022, obviously total basket case. I think we were all sitting at home at that point in time, wondering what was going to be happening in the pandemic. Q2 2019, lower volume than we are today. Q2 2018, pretty much where we are. So it's really, there's no warning bells going off here for sales volume in multifamily yet. Interesting chart. Let's look at GRM trends. So here's quarterly GRM going back to 2013. When I took over the company research. Before that, we had annual numbers. And it's been this slow, steady upward march. Properties getting more expensive. GRM is a great indicator of demand for multifamily investments because people are willing to pay more per dollar of annual rent. So Q2 of 2022, Q1, we're right here almost at that 19-ish range. Yes, we went down a tiny bit in Q1 to Q2, but that happened here and here and here. It's like hard to say that that's really a statistically significant movement yet on pricing as it relates to GRM. So still is basically flat. Cap rate, same story. Cap rate's been steadily declining over the last 10 years. Cap rate compression, if you want to sound fancy, and you listen to a lot of radio. From the mid 5s down into the 3s here in our area. And the interesting thing about cap rates is if you're looking at investing elsewhere in the country, that's been compressed now. And it used to be that you could go, especially, in and around here, 2015, 16, 17, you could go to other markets in the country and you could get a huge bonus on your cap rate for investing in other markets. You could get 200, 300, 400 basis points higher on your cap rate by going to some of those Sunbelt markets. Those got really popular during that time period, and now we've seen cap rates compress all across the country, and it's looking very similar to us right now. So a lot of people that I've talked to that are investing in some of these other markets in the country are surprised to hear that the cap rates we're seeing on stuff here locally are really not much different from what you might see in Phoenix or Dallas or Florida, or name your other market that's been really popular for multifamily in the last 2 to 3 years. But it's been more flat here, right? It had those markets, the cap rates have really gone down aggressive. So it's been pretty measured, but people have done well. Price per square foot, quarterly, last 10 years or so, steady march up, right? Same story. Basically flat Q1 to Q2, steadily up and up and up. We had a little bit of a discount there at the beginning of 2020. If you were very brave and you got a few of those deals into contract, congratulations. We had a few clients that did that. There were some momentary deals for about 6 weeks right about here. Those were good ones. Price per unit, same story. Steadily up. Nothing really to report there other than that. And then here's this other great leading indicator to look at. So we've been keeping monthly track of inventory of active listings in the multifamily space. This is all in that same geographic region, LAX down through Long Beach, 2 units and above, since 2018. And this is kind of when they started talking about raising rates the first time. And that it's no coincidence that this is when our monthly data starts, because everybody got really worried, right, about prices changing. So we're like, right, we're going to do monthly inventory data so we can really get ahead of it and see, when the deals are going to come. And here we are, 4 years later, and this is a very tight range in inventory. Any fluctuations that you might see here, you can almost 100% attribute to seasonal differences. Little wonkiness, obviously, in 2020 and what was going on there. But even, super high volume months here in 2021, inventory is right around 450. We had the lowest inventory we've had almost at all on this chart, except for at the very end of 19. This winter, it was really light. We were trying to find some deals during that time. There was almost nothing. Malcolm's nodding. There's almost nothing. It was so hard. And it's gone back up to the same range it's been, over these last 4 years. But if you only looked at this chart with this little short time period, you think, oh, it's kind of normal. We're in the normal inventory range. And hey, look, inventory's gone way up from December to June. So maybe that'll continue. And then, the supply and demand scales are really going to tip in the buyer's favor. And then there's going to be all these deals and these foreclosures and stuff. Well, let me show you what inventory looks like over a little bit longer time period, so you can actually get an idea of what higher inventory might look like in the event of a real estate downturn. So the part of our chart that we were just looking at is all right here, which all looks almost exactly the same when you zoom out this far. Zoom back to 2004, and even back then, this was a really healthy, strong market. Obviously, we were in the middle of the subprime boom at that point. 1,000 at a time was pretty normal. And then here's when you can really see the writing on the wall, right? Inventory goes up by 50% from 1,000 to 1,500 in 2006, 2007. And by 2008, inventory has tripled to 3,000 listings at the same time. I can remember looking at stuff around here, and it was all short sales. It was all foreclosures. It was wild. This is what inventory looks like when things are really going hairy. So just to give you a little bit of perspective and zoom out, we are not there yet. We are nowhere close. People probably freak out if we'd be getting back to here, but that's actually historically kind of a normal number in our market. So who knows? Maybe we'll never get back there because transactions happen faster these days, and there's so much sharing of information, and the digital world has changed. But I wanted to show these charts together because looking at this one, you think, oh, it's going up, and no, wait, it's not, right? Fascinating stuff. Okay, so back to the market study, just to refresh your memory a little bit. I know everybody's here to talk about inflation and interest rates, and I've totally ignored that topic for a minute. So let's talk about it. Here we are. So this is just straight up price per square foot. And so within this number includes appreciation from increased demand, as well as appreciation from inflation, the erosion of the value of the dollar over time. And so inflation is your best friend when you're a real estate investor. If you already own property, other than what it does to interest rates, it's your best friend. So let's look at that a little bit. Here's this chart that we've already seen in regular dollars of the year. Here's this chart adjusted for inflation in 2021 dollars. So if we take inflation out of the picture, this is what it looks like. So this, you could say, is a more pure representation of changes in demand for multifamily real estate property in this area. So kind of interesting, really, right? Demand drops and it comes back. But even though inflation is backed out, we've had a significant increase in demand for this property type going back to the 60s, even if you back it out completely. And interestingly, during the last period of super high inflation, look at what happened to demand. Even though we removed inflation entirely from the 1970s numbers, a lot of the increase in value in property during that time was a result of increased demand for multifamily real estate. Probably because of the inflation, right? It's a great place to put your money during those times. All we think about is, oh my gosh, inflation was out of control and interest rates went crazy. But this is a really interesting chart to look at when you're comparing the mindset of investors. And the question is where we go from here. So here's that same value study. And we dug up a really old chart that had GRM going back to 1965 as well as rents in cents per square feet. So this one's a little hard to read because we have 3 metrics on here, but over here is the price per square foot and rents per cents per square foot for rents. So this is price per square foot in dollars for sales price, and the red line is in cents per square foot on rents. So obviously, it's just gotten more and more steadily more expensive to rent. That's been a more even march as rents have grown during this time. Obviously, that we expect that to continue to happen. Owning property during inflationary times, not only does your value go up, but your rents go up a lot. With a 9.1 June to June inflation rate, you can raise your rents by 10% right now, even with California rent control. So you get nice healthy increases. But seeing where the GRM was during some of these other decades is really interesting too, because this is hard information to find. So the GRM, the lines on this chart are confusing. The lines correspond with the hundreds over here. The GRM, you kind of have to eyeball it over here on this side. So, back then we were below 10 times gross in the 60s, 70s, got more expensive in the going up to the early 80s. That was when that demand all came up. 90s. The early 90s was a rough time for the real estate market, as you can see. And then here's that big boom in GRM during the subprime boom. Came back down, lots of deals in here. And then we've had this kind of slow, steady increase on GRM ever since. So let's overlay that a little bit, because these are some of the questions a lot of people are asking as well right now. So this is a great chart. You'll see this in a variety of formats on other commercial real estate platforms and research shops. And what this is the GRM from our research overlaid over the 10-year treasury yield. So keep in mind that the GRM from our research, like I mentioned before, is different from the GRM on what you might see from other sources of research, because we include those 2 to 4 unit properties. And this is also local number. So this is only that greater South Bay data set. This does not include the whole country and so on. So our GRMs are generally way higher than you might see in a corresponding chart to another area. And really interesting stuff, because the first thing that people are thinking, right, is as interest rates go up, GRMs have got to go down, because that's what happens when interest rates go up. It gets harder to afford things. We have to put more money down. So it's only natural that as rates go up, pricing is going to come back down because it's harder to qualify for loans. It's going to cost us more to borrow every dollar, and that there's going to be that inverse relationship between GRM and cap rate, right? Well, it turns out that's not really the case. And the really interesting decade, and I was super happy when we found this data in a binder in hard copy here in our office, was that 1970s cycle is probably the most interesting time to study compared to where we are right now. That's the last time we had a lot of inflation in the market. So as the 10-year treasury rose from, the treasury yields here on the left, rose from 4 to 14 during this 15-year period, gross rent multipliers went from 8-ish, really hard to read, sorry guys, up to almost 15 in 1981 before they came back down at the same time as rates. Very strange, right? This is counterintuitive to what all the news is telling you is going to happen right now in the commercial real estate space. And I don't get it why they don't look at this information, but whatever. It does move sometimes in opposite directions. And so I think the answer is it depends on the conditions in the economy and in your local market at the time that that's happening. It's not as simple as saying, well, rates are going up, so there's going to be deals. Prices are going to come down. Everything's not going to be worth as much. It just doesn't go that way, right? It remains really to be seen what's going to happen here. We've been tightening rates really only since the beginning of 2022, so it's very early to tell. Our 10-year treasury right now is up at 3, so that would be right in the middle of this. This line ends at our like average so far for 2022, but the 10-year treasury is at 3 right now, and our GRM is at like 19, right? So huge spread there. The other chart that you'll see probably more often from one of our larger competitors, who shall remain unnamed, is this one. The cap rate versus the 10-year treasury spread. And again, these are different metrics than what other people might use. Most people use CoStar. We'll get into some CoStar data in a minute, but this is our own research. So a lot of people talk about like a spread a risk premium between the 10-year treasury, which you would identify as your risk-free rate if you're an investor, and the risk premium that you would require to take on the risk necessary to invest in an apartment building that has tenants to deal with and all that, repairs. And this fluctuates a lot too. So this is a really interesting chart, but the answer is it moves in the opposite direction as the GRM because there's an inverse relationship between those two. So we adjusted the cap rate in the same way that we did on the methodology for our market study here. This is a 35% expense ratio applied to the same GRM metrics we were seeing on the last chart. So again, the 10-year treasury here in orange, the cap rate in blue. Would have loved to be able to buy stuff at a 9 cap, but cap rates just kept going down and down and down as rates went up throughout the 1970s, and then fluctuating around in that range through the 80s, up a bit in the early 90s. That was a rough time for real estate, savings and loan crisis, and then down, 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 down during this large prolonged boom, subprime boom, aggressive increase again during the subprime crisis, and we've had this steadily lower, lower, lower trend in long-term interest rates throughout that time. So I don't think we can say that just because interest rates are going up right now, that necessarily cap rates are going to have to go up as well. That is not what happened the last time we were in this situation. And so it's silly to me to make the argument that that's exactly what's going to happen now. I think the real answer is we don't know. But where do you want your capital sitting in times like this? Okay, so now we did another really interesting chart. So same chart, but we took the 10-year treasury, and it's really difficult to estimate what commercial lending rates for multifamily might look like at any given point in time. There's not a really convenient index for that. You could say there are a few, but banks tend to price based on a margin above the 10-year treasury or whatever other margin they use LIBOR sometimes. But if you think in general broad market terms, we could pick a margin above the 10-year treasury that historically would indicate at least kind of a general range of where you might see commercial real estate debt interest rates. And I think that's probably about the 10-year treasury plus 1.5%. So what we've done is we've taken that same chart, we've moved the 10-year treasury up across the board by 1.5%. I'm sure this is totally wrong if you went to an individual year, and rates are probably going to fluctuate around depending on each bank's appetite for what they want to lend on and how competitive they want to be and so on. But I think this is a general approximation of a comparison between the interest rate you might have been able to get on an apartment building purchase at that time versus the cap rate that was available in the market at that time here. So another common thing I hear from a lot of people is, well, I never want to buy an apartment building where the cap rate is lower than my interest rate, which makes a lot of sense, right? If you're borrowing funds at 5% and you're buying an asset that yields 4.5%, that sounds like a bad use of borrowed money. And I totally understand that logic. Makes all the sense in the world to me. Obviously, real estate has, there's more to it when it comes to the returns. You get the appreciation, you get the tax benefits, you get the principal pay down, and then you also get the rent growth. So cap rates on a purchase are really a snapshot in time, but the cap rate that you experience throughout the ownership of your property is going to change based on what your rents do relative to your cost of funds, which remains fixed. So it might not be a terrible idea to buy a property at a 5% interest rate at a 4.5% or even a 4% cap rate if your interest rate remains fixed for 3, 5, or even 30 years, and you're raising rents at 10% per year. And especially in an inflationary period, again, this chart really bucks that advice that you might hear from a lot of investors that went to business school and learned that there, like myself. So here we are, look, right? Cap rate way lower than the 10-year treasury plus 1.5 for 25 years. So the data can't be that far off. People were obviously willing to do this, and probably for good reason. So really, I would just challenge you to unpack your reasons as you're considering what to invest in right now. There's a lot of fear. There's a lot of people wanting to sit on the sidelines and wait to see what happens because everybody thinks we're doing this again. In reality, we might be doing this again. And the data is more likely pointing to this, or at a minimum, something like this. Here's a more detailed zoomed in chart. I've shown this one a bunch of times on these meetings before of the 1970s. This is overlaying interest rates over that same price per square foot. So as interest rates in 1972 went from 7% to 16% in 1981, price per square foot for multifamily in our area went from $17 to $86. That's a 406% increase, while interest rates more than doubled. I just love this chart because it's the opposite of what all the news anchors are saying right now. So I have to show it. Again, I have no idea what's going to happen in the future, but if we look at the past and we try and find some allegory there, I feel pretty good about the stuff that I own. Here's a little inflation calculator. It's just what happens to your money over this time period. So this is unpacking this from 1973 to 1981. Average rate, 10-year rate at that point was 8.45% inflation. And an inflation calculator, if in 1973 you purchased something for $600,000, in 81 it would have been worth 1.2 million bucks. And by the opposite ticket in 1981, in 1970 at 600, in 1973 it would have cost you 293. Very real what's going on right now. That the pain people are feeling from inflation, the pain that consumers are feeling is real. This is a global phenomenon, and in fact, the U.S. is better off than most other countries in the world. And it looks like the dollar is remaining the king for now. So, pretty great place to put capital in an inflation-protected investment in the safest country in the world. So, okay, let's get into the cap rates or the CoStar stuff. So, starting here is a whole bunch of data from CoStar, which is kind of the gold standard in industry research for commercial real estate. I'm going to blow through this a little faster since you could probably get this from other sources, and I want to give Dave some great time to get into the residential space. But they have really good data on vacancy and rents and trends at a broader level. This is from the local LA area from CoStar's reports. So here's our vacancy chart. Stabilized versus overall vacancy is just the difference between like new construction, basically. So you can look at stabilized vacancy, and it's a story of super low vacancy rates. You talk to the property managers here in the audience. I saw Chris Jenks, there he is. I see Michael Borba joined us, and I know vacancy rates in their portfolio is probably in the 2s. So anything that goes on the market's immediately rented. It is a great time to have some units to lease because you will get eye-popping numbers on the rents and they will lease almost immediately. Our clients are super excited about that right now. Great time for that. There's a huge shortage of rental housing. We just can't solve it here in California. We need to build our way out of it, and we're not. Call your elected representatives for that. Vacancy rate, this splits it out by, CoStar uses a star rating, and so you might hear that class A, B, C is similar to their class 3, 4, 5 stars, the nicest properties. So Los Angeles overall is this green line, and then obviously the super high end stuff tends to have the more cyclical vacancy rates. A lot of this is from new deliveries for new construction too. That's generally going to be 4 and 5 star stuff. So not a whole lot there. Vacancy rate by bedroom is always kind of interesting. Studios are the blue, orange is the 1 bed, 2 beds are green, and so on. So studios do typically have a little higher vacancy rate, a little faster turnover, but they also rent really fast. So right now they're going really fast because those are the cheapest units in the market. But this is pretty normal. Vacancy is still just super low on all bedroom counts. Market rents up and to the right, going back to 2000. So this is Los Angeles average, and United States is green. LA effective rent, and asking is basically kind of in lockstep here. Moving along, this would be the average rent per unit. So we've now crossed well over the 2000 mark here in LA, and the national average has grown a ton too. Asking rent growth, super strong. So like I said, numbers that I wouldn't have believed you'd be able to rent your units for even a year ago, we are now getting easily. So great to see as an existing owner. Really great case for investing in new properties. And that again drives back to that argument about thinking about what cap rate you're going to be able to achieve maybe a year into your business plan versus what your going in cap rate might be. Asking rent by bedroom, kind of an interesting chart here where we are. Studios, over $1,500 for studios now. 1 beds approaching 2,000, 2 beds over 2,500. 3 beds, well over 3,000. Amazing rents in LA. Job growth is that crazy pandemic V-shaped job growth chart, but it's looking pretty good, and jobs are coming back. If you read the latest jobs report nationally, 270,000 payrolls added last week. Yet apparently we're going into a recession, so I don't know what the heck that means. How can we be in the threes on unemployment and have 270,000 jobs added, but we're in a recession? Lots of mixed messaging here, right, in the economy. That's why everybody's so confused about where things are going. What chart am I looking at here? Median household income continuing to rise. Perhaps we're seeing the beginning of that wage price spiral that causes inflation to continue, perhaps not. Incomes have risen considerably. Population growth. So this is the LA versus United States. Down in 2020 for the pandemic, back up. Same thing with LA. People moved out of town, moving back in. And we're projecting population growth to come back to Los Angeles area at the end of this year. This would be the favorite chart of people loving to invest out of state and talking about how everybody's leaving California and it's a ghost town and it looks like the zombie apocalypse. Well, you do the math on this, we lost like 70,000 people or something, right? It's like, so not enough to move the needle. I know Dave's got some better data on that, but it's pretty funny. There we go. Net population change. I was wrong. A little over 100,000 people in a city of 10 million. Those are my data points. That's our research. Thank you. We can have questions in the chat. I see that there are some. Maybe I can answer a few of them while Dave preps his slides if we have some that are related to multifamily, and then he and I can tag team any other questions that we have. So let's see, I was on full screen mode there. Out of space to build, indeed. Hollywood, yeah, buying billboards, begging people to prevent the neighborhood from turning into New York City. Yeah, sorry, unfortunately, that's what we need. Otherwise, everything's just going to get worse and worse and worse. So if you have questions related to the multifamily commercial stuff, feel free to throw them in there. I will answer you now, or we can have Dave go ahead, and as you think of questions, throw them into the chat, and we will have a discussion after he does his bit. Take it away.
Cool. Thank you, Anthony. Great stuff. It's funny how some of the numbers kind of overlap for single family and multifamily, which you would expect to a certain extent, especially since, you know, also I'm going to be sharing slides that are very much about the South Bay and the greater, you know, kind of South Bay region. So I'll start off with anecdotally, and just to make sure everyone can see these slides, correct? We're good? Good. It's a lot of head nodding. So as Anthony mentioned, I do run Core Real Estate Group. We are a residential single family. We do a little bit 2 to 4, but we're mostly single family, brokerage that we represent. We do a mix of both new construction sales as well as resale. So I kind of have in my personal business a mix of that. And part is because we invest in ground up new construction as well. As Anthony just mentioned, the only way we're going to get ourselves out of this problem is to build our way out of it. And California has a lot of complications in building. So that's one of the reasons why the numbers that Anthony's showing on rents and GRMs continue to rise, regardless of what a lot of people think. California is still especially Southern California, a very desirable place to live. And it's a very profitable place to live. We have a lot of opportunity here that a lot of people don't have in other parts of the country. So anyway, I don't have a lot on LA today because I really think diving into, kind of what's happening. And actually, I'll start off with a shameless self-promotional plug. So next week, we're doing our first Zoom meeting in person, which is, collapsing or correcting what's happening in the real estate market. We've got three people that will be speaking on a panel. Brett Leitner, who's a residential and kind of a multifamily lender, who's has a few slides here that I've stolen in my presentation, which I will give him complete credit for. Gary Lipsky is a multifamily investor, mostly in Arizona, and Robert Fergoso is a kind of residential fix and flipper, mostly here in Southern California. So, we're going to be talking about it both from the, the home ownership side to the single family investing side to the multifamily investing side, California, other markets. Should be a great meeting, and I am going to post. Oh, can't believe I pulled that off. So just put in the chat the link on Meetup for our for this meeting next week. If you've never been to a Phoebe South Bay meeting before, we meet in Keller Williams, in my office in Keller Williams and El Segundo at the Point. And then after the meeting and the presentation, we all go down to the bar at North Italia and we do networking. We provide the appetizers, you buy your own drinks, and it's a great place to meet people. And honestly, for those of you who've never been to an in-person Phoebe meeting before, all this data is great, but the real benefit of being a part of Phoebe is the networking part, which we're slowly starting to integrate into our schedule as well. So I hope to see all of you soon next week. All right, so I'm going to cover kind of four main areas. First of all, earlier this year, I had because I'm part of Keller Williams, I got to go hear Gary Keller speak and talk about kind of his viewpoint on where the real estate market was going. And this is in February of 2022. So there's a couple of great slides that I think kind of set the table before we had that real dramatic spike in interest rates. So I've got a couple of things here that also do a great job of kind of looking at things historically, and you'll notice the patterns of the charts we were just looking at with Anthony, both exist on the residential and at a national level as well. And then, Brett actually had some really great slides from presentation. Both Anthony and I had the pleasure of hearing, talking about what happens to real estate during a recession. So we'll look at that relative to interest rates historically. And then I've got stats for LA County so we can get a real-time look. My stuff is more month to month. I have not been keeping track of this data for 56 years, with Mr. Buckingham, but my good friend, Mr. MLS, has been. So I'm able to leverage a lot of that data, which is what we'll kind of go through today. And then at the very end of it, we will have time for questions. If you want to get a copy of these slides, I have my email address at the end. Send an email address and I can send you these slides as well. All right, so first of all, again, I want to thank my really good friend, Gary Keller, for allowing me to use his slides here. So this was his vision speech at our family reunion. And, we've been talking about a shift coming in the market for a long time, which, by the way, if you're into real estate, you want to read a great book about what happens to real estate, during a shift in the economy. It's called Shift. It's one of Gary's better books. And, looking at home prices annually, when you look at it, and this is back since 1990, nationwide, these are nationwide data, not Southern California, but nationwide. The long-term average for real estate's been about 4%. And when you look at that, you can see we have been pretty consistent on that path until 2002 and 3 happen. And then we have this phenomenally wild banking moment, right? Where all of a sudden the number of loans were increasing because the criteria that they needed to give loans was decreasing. And as we start to peak up above what has been historically average, right? Of course, we have the correction in 2008, and then the opposite happens. Real estate prices drop just as much as they went above that curve, they dropped down to that curve. So I think it's important to look at that, because when you look at what's been happening with real estate since 2012, which is really when Q1 of 2012 residential real estate, I don't know what happened. All of a sudden the switches got flipped on. Everyone decided it was time to buy, and we've been on a pretty steady increase on real estate prices ever since. But we never really eclipsed that 4% trend line until 2021 last year. And even, even when we were projecting out to 2022, this is back in February, all the people at Keller Williams that look at this data were really projecting that we were going to finally start to level out. We all saw what was on the horizon, right? We knew inflation was starting to get creepy. We knew rates were going to start to go up. The Fed was already giving signals they were going to start pushing rates up. So the projections, for this year were to start to stabilize, and things would start to kind of, I guess, retreat back to the trend line. And I think that's a lot of what we're going to see as we kind of go out, through this presentation. One of the things that we've been talking to our clients about is there used to be this thing called seasonality, right? Where before 2020, when there was this post-pandemic boom and the world went batshit crazy for the last 2 years, there would be times of the year where real estate would get a little slower, and then all of a sudden it would increase again. And I think it's important that while we think there was no seasonality, if you actually look at where we were, this data is just from January of 2020. So this is really only going back about 2 years. I think, first of all, it's interesting to look at interest rates. Anthony, I know you mentioned in your presentation that rates really kind of started going up and, right around January, February this year. Actually, rates have been going up since December of 2021, excuse me, right? That's really where we bottomed out on rates. And I know a lot of this stuff because in some of the new construction projects, as you get into these longer escrows and rate locks, as rates start to move, that creates complications for the buyer and the seller. So we've been dealing with rising interest rates really for almost 1.5 years now. But when they were rising and they were in the 3s, no one really cared, right? All of a sudden, when they started rising and getting in the 4s and the 5s, that's when people really started to react. But even in one of the hottest real estate markets in the history of mankind, you can see we had a little seasonality, right? When you look in kind of May, June, all of a sudden numbers kind of start to tail off a little bit. They dip in January, they increase in the spring, they dip in the summer. And that's just because people like to go places, right? In the wintertime, we like to visit family, we have vacations planned, and no one wants to take on the purchase or a sale. I shouldn't say no one, but if you had your chance, you would rather not take on a real estate transaction if you were planning to go out of town. I bring that up right now because I think, if you're reading a lot of local news here in the last month, a lot of people are saying the market is changing, and that is true. But how much of it is just based on the fact that we've got seasonality, right? We're another year removed from the heart of the pandemic. I don't want to say the pandemic is over because it's not, but certainly travel restrictions have eased up and continue to ease up. And I don't know about you guys, but I'm so tired of looking at people's vacation photos from the month of July. Everyone was traveling everywhere. And I think we kind of had about a month where the market started to, kind of correct itself a little bit. But I don't know how much of that is because of rates increasing or, there was some radical change in demand or supply. I think people just got busy with travel. And, here we are now in the last, I'll say 6 weeks. We also saw a decrease in interest, but the last week, ever since July 4th, we're starting to see an uptick. We've gotten a lot more market activity just in the last week. And we think the further we get away from July 4th weekend, which we kind of peg as the heart of the travel season, I think we're going to continue to see an uptick the rest of the year in market activity until probably the end of the year. And then it'll probably decrease again. So this is a huge one for me. And, this is looking at historically the distressed market. And, when you look back, this doesn't even include what the distressed market looked like in 2008, 2009, 2010, that those were off the chart on this chart. Just looking at the last couple of years, we are historically, our distress has been at 6%. Even in 2010, 2011, we're just starting to come out of the recession. We had a quarter of the inventory was distressed. Right now we're at 2.1% as of Q3 of 2021, which was the last time this information was run. So if we have had an increase in distressed inventory, which we haven't, spoiler alert, it's been pretty steady. A lot of people that were doing some voluntary were taking their payments and putting on the end of their loan. People that weren't making payments on their mortgages have worked out some type of deal. There's been a very, very low amount of distressed inventory, and that still continues today. So, really to get to a point where you're going to have price corrections and it's going to become this rabid buyer's market is when we get into an oversupplied market, which we are very far from. So looking at inventory annually, again, this is national data. In 2021, we were up to a 2.3 month supply of inventory, and I've got some of these numbers in our local data when we start going through it. But to Anthony's point before, it used to be that LA was this one kind of real estate market, maybe New York, San Francisco, and every place else in the world was saner and it felt like it had higher cap rates. Well, that's changed. Across the country, demand has gone up in all markets. And because cap rates were so inexpensive in Tennessee and Austin and Phoenix, all that money went there, drove those prices up. And now those real estate prices are pretty much on par with where we are in Southern California. And then the last one, talking about new construction home starts. We have been chronically underbuilding since 05, 06. Our long-term average is building about that's actually 1 million homes per year. And we dropped way below that, post recession in 2009, 2010. And 2021, we were finally starting to make some progress, getting back ahead of that. And if you've been reading any new builder data news, new housing starts are starting to tank again. Which is one of the things that I think is going to be a trend that will come out of this current recession that we're in. But it's not because they don't see a decrease in demand. It's because they're tired of dealing with supply chain issues. The money to buy, to lend on is raising as rates are rising. And then, they still have existing projects that they just want to get through. So new construction starts are starting to decline. It's not reflected in this chart, but that's kind of what's happening, which is going to impact our inventory moving forward for the next couple of years. All right, so that's kind of a look from a nationwide perspective, historically looking at prices. Brad had some great information in here about how housing, and this is more single family based, but you could probably correlate into, especially the 2 to 4 unit stuff, some of the same type of conclusions. And, it's no surprise to anybody, but, whenever the Fed raises rates, right, we tend to go into a recession. It's exactly what they're trying to do, right? They know that inflation is getting high, the market's getting rabid, and to cool things off and balance it out so it doesn't get out of control, they raise the rates. And then quickly what happens is as soon as we get into recession, interest rates start to come down. And you can see this has happened in every single recession we've ever had, right? Except for 2000 and this is actually right around 1995, rates were going up. And then they immediately started lowering it because, this is in 1983, the Fed was raising the rates. And because they sensed the recession was coming, they quickly started dropping them and we never officially got into a recession. And then in 1995, 97, 98, rates were rising. And then we kind of had the internet boom, that crashed, and we never officially got into a recession. But for the most part, whenever the Fed raises the rate, a recession follows. And as soon as we're in a recession, then they'll start lowering rates again to stimulate the economy. As we talked about earlier in the presentation, we've already had, kind of the most blanket definition of whether or not you're in a recession is when you have 2 quarters of negative GDP growth. We did have first quarter, I think it was negative 1.2% GDP growth, and a lot of projections for Q2 are in the negative 2% range. So even if they're off, 100 bips, we're still looking at another negative quarter. And maybe by the end of this month, we will start having the conversation that we're actually in a recession. And historically, whenever you've been in a recession, real estate has actually done fairly well, right? Real estate, kind of gives you some leverage against the stock market and more liquid assets. And if you look at where what's happened with real estate prices. So this is the S&P, the Case-Shiller, the national housing price index. And we look at when there's recession. The only time this didn't happen was in 2008. And it wasn't because, I think if you look at what happened through here, and the next chart has rates, is even though we were in a recession, right, rates started to lower and banks were still giving loans. Now the rates were higher because they'd been pushed up to the recession, but you could still get a loan. In 2009, 2010, it didn't matter what the rates were. No banks were lending. Their balance sheets were so screwed up with all these toxic assets from the lead up to that, right? So a lot of this recession, besides the artificial inflation or bubble that we had based on these really loose lending criteria, really what you have is you just had a lack of lending. But something happened in 2011, 2012 is we passed a rule called Dodd-Frank. And I'm a realtor. Sometimes it's a pain getting someone accepted, running through all the different hassles and barriers you have to go through Dodd-Frank. But what's happened is it's stabilized our real estate market, right? And what we're not looking at is 25% of these bad debts at 100% ARV loans. I actually got a loan for 105% ARV in 2005. So, those types of loans have not happened over the last 7 to 8 years, which is why our distress inventory is so low. And if you look at historically, not necessarily there was a rule in place, but just how banks behaved, historically, real estate survived recessions pretty well. And then looking at rates and what happens in recessions, here's the proof, right? I think we all know it just anecdotally, but when there is a recession, the Fed's like, hey, we did our job, hooray for us. And then obviously they get political pressure. They want to start stimulating the economy and getting positive GDP growth. So one of the first things they do is they start to lower the rates. So I think that's important. Anthony, you were mentioning before about people buying property even at these really high interest rates. What we like to tell people is that you actually marry the property, you date the rate, right? Rates can be changed out. Getting an asset is what's important. As rates come down, and they will, right? As soon as we get on the other side of this recession, the Fed's going to start lowering rates again. You're going to have an opportunity to refinance.
I love that.
So, that's been a lot of some of what our advice has been to our clients. Yeah, date the rate. Yeah.
I'm gonna steal that line. I'll give you credit. I'll give you credit.
Permission. I stole it from someone else, so don't think I classically invented that. So, kind of with that perspective of where the housing market is in general, let's actually look at on the ground what's happening here in Southern California. And first, I'm going to start off with LA County, and this is all property types, right? So this is only 1-unit properties, but it's condos, it's townhouses, it even has some manufactured homes in it. And this is everything in LA County. And you can see this is the actual volume of closed sales. And our peak, this is sometime around actually June of 2021, a year ago to, this past month is when we kind of peaked on the fever of the number of transactions in the market, right? This is when people were doing Instagram videos of all the crazy things they would do to buy your house and give you the pony and all. This is when being a listing agent was really fun, because you just put a sign in the ground and you'd have 7 offers the next day, right? That's that market. That market has kind of been starting to cool off just because I think, a lot of buyers got frustrated and quite frankly, rates were rising, right? Even kind of through here, they were slowly starting to creep up. And then it really wasn't until this time period here where you see the big jump, 300 basis points in rate increases. And so, but transactional volume was still happening through this year, right? Dropped a little bit, in May, but in June, we actually had a bit of a bump up. So, as we've been kind of talking about, if you look at this, it kind of looks like we're starting to stabilize a little bit, right? We came down, we're kind of coming back up. I kind of think this, right around this, 5,000 to 6,000, units a month is probably where we'll start to see the market going here in the next few, maybe next year or so. Looking at active listings are on the way up, right? So you may see a stat at some point in time that says, look, month over month, active listings are up 177,000%. Well, that might be right, but look at how low we were, in the last couple of months. If you look at where we've been historically, and again, this is LA County, at the end of June, we had 12,000 active properties, which is a radical increase from February and March, but still, even post pandemic, in 2018, we're still well below where we were historically on the number of homes that you actually had a chance to buy. So we're still absolutely in a low supply environment. And then looking at median days on market, we are noticing that it's starting to take a little bit longer. Our days on market is increasing, not just in my listings, other realtors listings, other realtors in Keller Williams throughout the South Bay. Everyone is seeing it, and everyone saw a real big dip in activity kind of mid-June, probably until about a week ago. But all of a sudden, this last week, you're going to probably see, if we were to run these numbers in July, that's probably where we're going to see the big dip. But then all of a sudden, August, all this business that we're starting to do now in July is going to come to light August and September, and we'll start to build up again, which is what is called seasonality, right? So we're starting to see some seasonality in the real estate market that really the last couple of years, the low interest rates just kind of blasted through. And whenever you're in a low supply environment and you've got demand more than supply, prices continue to rise, right? We've been on a real steady increase. Really, this little point right here, which is the March of 2020, this is when we kind of had the 6-week bump. And Anthony, we have one client of ours that did a deal. They got the property about $100,000 under where market value was, and by the end of the transaction, the market was already coming back. And we spent the last 2 weeks of the transaction trying to keep the seller from canceling on our client because they wanted to get it back on the market.
We definitely had some of those. Yeah, it was so fast moving.
It happened quick. So a lot of vacations got canceled and a lot of realtors made a lot of money here over this last year and a half. But as you can see, it looks like we may have peaked sometime around April of 2022. And we are starting to see a bit of a correction, not a free fall, just a bit of a stabilization on where median sale prices are here in LA County. So next, I'm going to kind of dive into some of the subregions. And while Anthony mentioned, when he looks at it, he's really looking at that kind of that 605 or the 105 to the 605. Really, my numbers are more like, I'll say Santa Monica down to Laguna Beach, right? So we're looking at where the greater LA real estate markets are single family. I think it's important to look at all three of the main regions. This is actually pulled together by the Realtor Association. So South Bay Board of Realtors, basically covers the greater South Bay. The Pacific West mostly covers Long Beach and Orange County, and Beverly Hills, greater LA kind of covers, Santa Monica over to downtown. There's a bunch of other ones, but these are the three biggest. And so this is what these numbers are run against. So the first thing we're going to look at, once again, is actual closed transactions. And when you look at the Beverly Hills, greater LA, we actually are down on the actual number of transactions from 2022, June of 2022 to June of 2021. But we're also up pretty big over June of 2020, right? So June of 2020 is when we started kind of coming back out of that very, very small blip of a recession that we had in 2020, right after the pandemic. And as we talked about at one point, it was the K-shaped recovery, and it was very, very quick for some of our population to recover from the pandemic. But we're down kind of across the board. Even the South Bay, we're down from the actual number of transactions, but we're up from 2018. And then, Pacific West is probably the biggest of the three associations because it does cover a larger geographic area going all the way down to Orange County. And they're pretty much the same. So we're kind of in that, low 20s to low 30s range, and a decrease in sales. So this will be something that we'll keep. I think we'll see a bigger decrease in July, right? Which we won't get that data till August. And then in September, when we get the August data, I think we're going to start to see a bit of a run up again. I think the next 6 to 8 weeks are going to, people are kind of coming back to real estate shopping. And the reason why is because if you're a buyer, you actually think you can get a deal right now, and you can. Right, we are starting to balance. Right, if you're a buyer, you're no longer competing against 15 other offers. You might only be competing against one. We had an FHA offer accepted today, which was awesome. We had a VA offer accepted a week ago, which was awesomer. And those are two loans we never would have gotten accepted a year ago because no one wants to deal with VA or FHA. So, we have a lot of buyers that have been kind of sitting on the sidelines waiting to pounce. And yes, they are going to be spending more in an interest rate, right? So if you've got $1 million home, let's say you're borrowing $700,000 for that, let's say 750, maybe your interest payment or your mortgage payment is going to go from $4,000 a month to $4,400 a month, right? So that $400 a month in extra interest you have to pay. But you don't have to outbid the guy next to you $100,000, right? Release all your contingencies, close within 7 days, and then take all this risk. And you can refinance 2 to 3 years from now when they start lowering rates again. So that kind of mentality, I think, is going to keep our demand up. At the same time, from a supply side, we have had 2 potential listings that have canceled because they have a 2.5% interest rate. And if they sell their property and buy another one, they don't want to have to re-enter at that 5.5% interest rate. So they're just going to sit tight for a couple of years and wait for interest rates to go down again, see what happens in the market. So I think we're still going to be in an imbalanced market over the next couple of years. But it's going to create more stabilization than it's going to create a correction or a major drop. Looking at months supply, we are still at a relatively low number. I think it's interesting when you look at where Beverly Hills, LA was in 2020, they almost were at a balanced market. They were at 5.7 months. 6% is considered a balanced market where you have an equal amount of demand and supply. But man, they had dropped, and they're still continuing to drop, even now. So there's a lot of demand right now in kind of the LA, Beverly Hills area. We're actually going the opposite. We are starting to pick up a little bit here in the South Bay and Pacific West, kind of that Long Beach, Orange County region, but we are still well below where we were in 2020. And then same thing with active listings. We are starting on all 3. We're starting to have an increase in the amount of available properties. And I think, again, we'll see a big a bigger jump in that when we get the July numbers. But we are still historically, for the last 2.5 years, lower than where we have been on, from over the last 3 years. So, we still have a lot of room to go. And if we were to look at this over the last 15 years, we're well below where we've been historically from the number of active listings that a buyer has to choose. And then looking at sales prices, look at that. It's almost $1.5 million is a median sales price to be in the greater LA, Beverly Hills. Welcome to LA, brand new home buyer. South Bay is over $1 million now. And we actually got up, I think, it was almost 1.1, I think is where we were. That's where I think we peaked in the median for the South Bay. And then as you continue heading, to the Southeast, even those prices have creeped above the $800,000 mark. So here's where we're starting to see some stabilization on prices across all 3 of these regions of LA. All right, and then lastly, I wanted to kind of just give you, especially if you wanted a copy of the slides, what are the current median sales prices for some of the top markets in the South Bay, right? So, and a good 3-year look at those markets. So the first set, kind of looking at the coastal cities, Manhattan, Hermosa, Redondo, and El Segundo. Manhattan is now at $3.6 million is the median price of a home in Manhattan Beach. Hermosa is at $2 million. It clipped $2 million and has for the last 2 years. In Redondo, it's $1.5 million, right? Which is that same median price that we were just talking about in LA. And look at El Segundo. El Segundo has been on fire. El Segundo is approaching Hermosa Beach pricing, here on a median price. Looking up on the hill, because I didn't want to think about the hill because I knew Anthony would be sitting there going, hey, what about the hill, man? Because, now that he's a PV rat. So I added some PV numbers up through here. PVE, almost the same as Manhattan Beach, $3.5 million is the median sales price, up 35% even over 2021. This is in June. These are June recorded sales. So while we didn't have a lot of them, we still had rising prices. Prices are still going up. RPV up 9%, and Rolling Hills Estate is up 61%. It's almost $2.6 million median price for a home in Rolling Hills Estates. Crazy. Looking at maybe some more affordable investor markets, right? So some of our favorites, Carson, Lawndale, Hawthorne, and Lomita. We've been calling big opportunities in these markets, but even these prices are almost approaching, $1 million median sales prices. Lawndale still has, I think, a little room there. I think it's an interesting market to look at. It's pretty flat over 2021. And if you can buy things right now at 2021 prices, that's a deal, right? So Lawndale is probably a place to look. Hawthorne and Lomita are, continuing their upward trend. And then looking at Torrance, San Pedro, Long Beach, and Gardena. We have been screaming about San Pedro for 3 years, right? I still think it's a huge opportunity, both in the single family and the, smaller multifamily space. But look at those prices, up 25% over 2021 in June. Torrance is pretty steady. Long Beach, Gardena, they're all pretty stable. So, to Anthony's point before, which I think that's my last slide, it is, we are starting to see some stabilization. We're starting to see some balance. We are not seeing a collapse. And while that could change, I think my crystal ball shows that we're going to get this GDP number in a couple of weeks. And all of a sudden, the media is going to start screaming about inflation, right? Which is good. Inflation will hopefully calm the Fed down where they'll stop, at least they'll balance the rates out. Although I still think we have a few more rate increases to go. We're starting to hear reports of inflation starting to peak. Gas prices have been coming down. Retail inventories are starting to build. Container ships are starting, we're starting to build up some inventory through here. And then as we do hit the recession and the mental part, as companies maybe do start doing some layoffs and maybe we do start having some job reports go through, all of a sudden, eventually the Fed's going to start lowering rates again. And I think that's where we're going to get some good opportunity. And it's going to keep our market holding pretty strong, until we see this radical increase in supply. I think that we're going to continue to stay pretty stable here.
Very well done. Thank you, Dave. I totally agree. I think it's, the numbers sure look like, and the feeling, at least as a broker in the market, and I think you're feeling this too, is that it's a really good time to be a buyer right now, right? I mean, you can, all of a sudden you get to negotiate on some stuff, you get your regular contingencies, you might even get some repairs and credits. I mean, we've gotten some discounts off list price for deals going into contract over the last 2 months. That was unheard of.
It used to be, we sit down and say, okay, listen, first of all, it's really nice to meet you. Second of all, you're gonna have to waive your appraisal, waive your loan. You're gonna have to bid $300,000 over list price. And, buyers were freaked out. And all of a sudden now we're in a stable market, right? And even as a listing agent, it's kind of nice to have some stability. It's a pain to have 15 offers on a property. It's a lot of people that you have to disappoint because only one gets it, right? So totally. It's kind of nice to start having normal conversations again about real estate. And I think that's where we'll be for the next couple of years.
I totally agree. Yeah, it's a relief. It's exhausting to have it on both sides of the equation the other way. Yeah, and I totally agree. I think it's going to be that way for a while. It's a new reality, and the people that are going to be willing to participate, I think, are going to do really well here. But you've got to buy right, pick the right property, and be able to execute on what you're doing after close, and see if you can find a way to add value and take advantage of those, of the incredible rental market. And you have the opportunity to do really well.
Yeah, look, I think even we've been bagging on the recession in 2008, right? And what a shitstorm it was. But even in that period, rents for the most part stayed pretty stable and continued to increase, right? So, I think from either a residential or a multifamily, rents are starting to stabilize. Rents are just staying as strong as can be. We've got a couple of properties that we're renting out, and we're getting the same kind of lease offers that we were getting on purchase offers 6 months ago. One apartment will all of a sudden have 7 contracts on it. It's like, where did this come from?
It's the weird, and it's a great point about the rental market. Like, when can you actually remember rents really going down? Basically never. I mean, they went down. This is even hard to measure here, right? Over a span of 1 year in 2009 is basically the only decrease you can find anywhere on this 22 years of rents. It's amazing. Good to be an owner for sure. Okay, so if people have questions, feel free to throw it into the chat, or if you want to raise your hand, we can call on you and unmute. Marty's asking about why you think San Pedro is so hot in the meanwhile, Dave.
Well, I think the best answer I ever got about investing in real estate is follow the money, right? If you think about the money pouring into San Pedro, everything happening on the port, it's just everything happening in Carson, right? There's so much development happening, even in Long Beach. That's why Long Beach has just been booming for the last 10 years, is just because of the investment in, private public partnerships, big projects, a lot of big institutional government money happening. And that's absolutely the case in San Pedro. San Pedro is one of the few cities in the world where real estate got less expensive the closer you got to the beach, right? And that dynamic is now starting to change as well, right? When you get more towards downtown San Pedro, 5th Street, 7th Street, we've got a couple of new construction projects going up in those areas. And that it's just a market that was underutilized, underpriced, and it's now finally starting to come, it's finally starting to come back to where the rest of the South Bay is.
Great geographical characteristics and really cool character in all the old properties there too. I always thought that was a underappreciated part. It almost feels like kind of a little San Francisco down there with the hills and the old properties and stuff.
Oh yeah,
it's so cool.
Yeah, absolutely.
Great.
So yeah, I still think, and I think Hawthorne is a fantastic area as well. If you think about what's happening with SpaceX, if you think about the trains, they're getting ready to open up that line that's going to connect it to Santa Monica. All the development happening at the airport, Inglewood, that whole project at Inglewood is still continuing. The stadium's done. There's still a lot more construction happening through there. So, we're kind of, when we get a lot of first-time home buyers that we deal with, or investors, right? We do have some investors that are looking at, buying that single-family home, converting a garage to an ADU, which I think is a fantastic play. Hawthorne has a great supply of that kind of property, 5,000 square foot lots, detached garages, big driveways. And I think there's a lot of upside, kind of that North South Bay, El Camino Village area of the South Bay is a great place to look to invest.
I totally agree. Yeah, great spot, great location there too. You can get anywhere in LA from there, and good value.
Great value. Yep.
Good points. Other questions or comments? I know we covered a mountain of data and charts and everything. I'm surprised we don't have more here. Sam says we still see a lot of lots with 10,000 square feet. Yeah, there are extra large lots up there. They're generally smaller in Long Beach, but there's some huge lots up in Hawthorne where I think you could build extra units, get some ADUs on there, right?
Yeah, absolutely.
For sure.
I think Martin has a good question here. What's a better investment, multi or single family? I'll take the first stab at this one, because I think the more units you have, the better investment it is. But if you're just getting started, buying a single family and adding an ADU is such a great way to get to a multiple unit property. If you're buying it for investment, a single family rental is a great place to start, but do everything you can to add an additional unit. You'll get a huge return on whatever dollars you spend, especially if you're converting a space into an ADU versus having to build one ground up.
Totally agree. I was going to give the completely biased answer. Well, of course, multifamily, right, from the multifamily broker. But yeah, I mean, generally that's about scale. And I agree. You know, if you can get a single family property and there's a way to add value, you're going to get better rates, better terms on your loan buying single family than you will 2 to 4. And so if that's in your price range and you can do that, great, especially if you can own a rock, awesome way to get started and, you know, go with FHA or something like that. Really, really great way to go. But yeah, if you can scale, the numbers on multifamily are fantastic. You can control the value if you can control the income, which is just amazing. I mean, there's honestly, the business is so simple that if you know your rents, you know how it's going to go. And the predictability is just amazing. It's boring. And the boringness in the industry is like what makes it such a great investment, you know?
Yeah, we also have, quite a few first-time home buyers that are buying single family and renting a bedroom, right? So buying a 3-bedroom house and renting one out is another way to create multifamily, right? Just by buying a single family. So increasing your rent, increasing your revenue, right? With all those slides about NOI and how it affects GRM and cap rates and everything else, be creative in how you can add income. Which is kind of an answer to Sam's question about what's better, SFR plus ADU or duplex. It's a question we get asked a lot. And I think the question is how much do you have to spend to build the duplex? I think on some of Anthony's slides, what was the median cost per door in the South Bay? Like 450,000?
Yeah. 460-ish. Yeah, 460-ish.
So if you can buy a single family home and then create an ADU, you can probably create it and kind of get to that same balance, depending on, how expensive of a home you buy. But if you're looking in Lawndale or Hawthorne or Lomita or San Pedro, you can add that ADU. That might be a better deal, or it could be more expensive depending on how expensive it would be to add the ADU, in which case a duplex might be a better play.
Great point. Sam brings up an interesting question. I'm curious about your experience here so far. Have you had people buy, add ADUs and then resell? And what have you seen on appraisals on those deals if you've had people do that yet?
It's starting to stabilize, but it's still, I can't tell you one consistent answer of what to use. The rule of thumb we've been using is 75% of what we think the market value is. So if we think it's a market that's selling for $1,000 a foot and you build 1,000-foot ADU, then we would value that at about 750,000. And, depending on who the buyer is and how they come in, it will depend on what the appraisal looks like, but there's still no one rule of thumb on ADUs. But the more there are, we're starting to get better comps as well, right? More properties are selling with ADUs. So now all of a sudden appraisers are starting to have a little more comps. But, the suggestion I would make is if you're in that situation, do your research first, because you may find comps that an appraiser wouldn't find just because they won't spend the time. You might have to go out 2 miles, right? And say, well, look at this property versus this property, just because they actually have ADUs. And if you make a valid argument that show that, in this, maybe not the immediate sub area, but in a little larger general area, ADUs are impacting values relative to what the regular inventory looks like. That'll help your case when you're, meeting with an appraiser.
It's a great point. Yeah. I think I haven't even really seen too many deals trade either in the larger space that have ADUs, but I think you do get some benefit if you're adding ADUs to like 5+ buildings and that they just take the income and they're going to do the income capitalization approach. So that's easier. But I haven't seen a lot of those sell yet either. A lot of our clients are building them right now. I'm building some, but it takes forever. So got to be patient to wait for some of them to hit the comps.
So true.
What do you prefer, value add or stabilize? Good question. Sam knows my answer. So Dave, maybe let him know. What do you think?
Honestly, it doesn't matter what I prefer. I mean, investing is all about picking what's right for you, right? Investing is a very introspective journey. You have to understand what you're looking for. If you're young and looking to build wealth, then value add makes a lot of sense. If you're nervous and uncomfortable or old, buying stabilize makes sense, right? There is no one right answer for everybody. It's matching the deal based on your own taste, your own style, where you are in your life, your financial plan. I think what's important to really realize is that the ownership experience of buying something that's stabilized versus value add, or class A versus class C, it's a different experience. It's even if you have a property manager, they are more complicated projects to manage, which is why they trade in 6 caps and 7 caps, right? Because they're risky. So, but know your own risk level and buy what's right for you. Just don't buy to make the most amount of money.
Totally agree. Great advice. I'm a sucker for a value add deal, but at the end of the day, after putting in all the work and the money, like there's a great argument to buying something with a decent cap rate and really good debt that you don't have to do anything with. Like it's almost not worth it sometimes. I mean, yeah, you do well, but I totally get both sides of that argument.
And look, even the stabilized becomes a value add when you add time. Right? It may not be a value add that you can turn it around in 18 months, but put 5 years on it, put some inflation on the rents, and guess what? You've got a great value add, and now you are getting great returns out of it. So patience matters in that formula as well. How much time do you have?
100%. That's the beautiful thing about the game. Love it. Any other questions? All right, we got an exhausted audience digesting all of the economic and market data that we've presented. This is
I think that was about 3,000 numbers a minute over the last 2 hours, right?
That was a lot. Yeah. Sorry if your eyes are bleeding and you're yawning by now, but I could see we've kept most of the participants all the way to the end. Thanks for joining us, everybody. Here's a good question. What's the most common reason for multifamily sellers to sell? So this brings up a great point that I didn't mention earlier. By far, the most common reason you would sell is to do an exchange. And this gets back to Dave's point from the single family seller who's thinking about selling and buying another house, is from the multifamily owner, the prospect of an exchange right now becomes tricky because you might have debt locked in for 3 to 5 years, maybe even 7 years in the threes. And you could be selling and looking at exchanging into something in the mid 4s, or maybe even around 5, depending on timing by the time you're looking at buying something. And that's tough to wrap your head around, right? And get comfortable with taking on 100 to 150 basis points higher in your replacement property, because you're almost certainly not going to improve your cash flow situation. Now, if you went and you did the analysis on your ROE and you've got a ton of equity and you're considering doing an exchange, the numbers are still going to tell you should do it. And strategically, it's the right choice. But I totally get that that's not an attractive prospect for a lot of people. And I think to Dave's point about the single family market, that is going to cause inventory in the multifamily space to remain constrained for a long time. Those commercial loans generally in our market go adjustable either in 3 or 5 years for most people. They're generally fixed for 3, 5, or 7 years. Most people that we work with are choosing the 3 or the 5 year fixed option. And so we may be waiting 2.5 years longer before the reset on all those loans come due, before we might see some of that exchange inventory. So I would not be surprised if we remain in a super light inventory environment in the multifamily space for a long time, because the other reasons for selling are the D's, right? Divorce, dissolution, or I guess there's a bankruptcy, or whatever they call it. Yeah, distress, right? So if that's not going to come back and you've got a super low rate and your rents are going up at 10% and vacancies at 2%, that's no sale. That's just no sale. You're waiting. Oh yeah, that's it. Death, divorce, and dissolution. I remember now, right?
There it is. Yeah.
You're waiting for those 3 to happen, and then you've got all this demand on the sidelines pouring in to get it going. So, great question. It is typically the exchanges that are causing that to happen, and I don't, there's still some good exchanges to be done, but it's a tough sell for a lot of people that have a really low rate. All righty. Well, great to see everybody. It is almost 9 p.m. Thank you for joining us. Once again, Dave, thank you for all the work that you put in on your slides and your research. Fantastic job. Why don't you let everybody know once again about Phoebe South Bay next week, and throw a link in there if you can. Would love to see everybody join in person. I will be saying hello to Elsa, Anna, and Mickey Mouse, so I will not be there, but hopefully some of our Buckingham agents will be there. And we hope to see you.
You guys are usually well represented, so we'll look forward
Yes,
to
we
it.
are.
Yeah, post is there, so we'd love to see you next week. And yeah, come on by. And then we're also trying to get together another kind of Phoebe-wide event sometime in September. So we're working on a couple of
Perfect.
dates. Stay tuned. Hopefully, that'll just be a networking event. Everyone can come out and hang out, talk real estate, geeky things that we like to do.
That was a great time when we did it in the spring. We had something like 60 people here in the office. It was great to see everybody in person again. So we'll definitely have to do that in September.
Absolutely. Awesome.
All right, everybody. Have a great evening, a great week. Enjoy your summer. Have a great vacation if you haven't gone on it already. And we will see you soon.
Thanks, everyone.
Bye.